Hello everyone and welcome back to the sessions on financial statement analysis for CFA Level 1. Now, in continuation of the topic analyzing income statement, I'm sure you can recollect in the previous class we have learnt everything about revenue recognition. So how revenue is recognized, we have learnt that. Now in this class, in continuation of the same topic, that is analyzing income statement, we will be talking about expenses recognition. So if you just understand one thing, when you want to compute your profit or net income, what you would generally do? From your total revenue for the period, you subtract the total expenses for the period. So you have learned how to recognize revenue. Now you are going to learn how to recognize expenses, so that revenue minus expenses would give you your net income or profit. Now just imagine that if we were following cash basis of accounting, then recognition of revenue and expense would never be complicated, because every time you receive some money, you recognize an income, you make a payment, you recognize an expense, matter comes to an end. But we are following accrual basis of accounting, and that is why you have to take utmost care with respect to revenue recognition as well as expense recognition, because with that logic, revenue should be recognized not when it is received, but when it is actually earned. Similarly, using the same accrual concept, we would say expenses should be recognized not when the payment is made, but when the expense is incurred. And here the matching principle, or you can call it the matching concept in accounting, plays a dynamic role. Matching concept in accounting emphasizes that your expense should match the corresponding benefits. Now what does that line mean? See, when you are incurring any expenditure, be it any type of expenditure, it is going to give you some economic benefit. Otherwise you will not incur that expenditure, correct? You spend something on buying a book. Why? Because you are deriving some benefit out of that book. You make a big expenditure purchasing a mobile phone. What is that? It is something that you have spent which is giving you economic benefit. Now, if you are making an expenditure, it is definitely going to give you economic benefit without doubts. So, when should you recognize the expense? It is now stated that as per accrual concept and the matching principle, you would say expense should be recognized exactly at that point of time when the benefit of that expense is achieved by the entity. Let us take an example. Suppose I have purchased a machinery which has a life of 8 years. Today I have made a huge expenditure, say $40,000 I have spent for that machinery today. But the benefit out of that machinery I am going to receive over a period of 8 years, which will be considered as economic life of that expenditure. Expenditure is incurred now, but benefit is going to be accrued over coming 8 years. So logically, the entire cost of $40,000 I should not charge off as an expense now. I should gradually spread that cost over the period of 8 years. Now how it is done, we are going to learn that ahead. So the idea is to match the expense with the corresponding economic benefit. So suppose I am paying salary for the month of April to my administrative staff. Their service towards that salary will be only for the month of April. If I want them to work again for May, June, July and so on, every month I have to pay salaries. That means once I make a salary payment, the benefit is restricted to that period only. In that case, when you spend that amount, you are going to charge that as an expense. So the idea is to match the expense with its corresponding economic benefits. Let us do one thing. Let us write up some notes, and I'm sure you have written this heading, expense recognition, and under this heading let us write some notes. Net income equals to revenue minus expenses. We have already talked about this. In order to calculate the net income, expenses are subtracted from revenue. Expenses are the decrease in economic benefits during the accounting period in the form of outflows or depletion of assets or incurrence of liabilities that result in decrease in equity other than those relating to distributions to equity participants. Now, initially I have explained you this part, but the detailed explanation of this part is yet to happen. But what I would suggest is quickly write up this whole thing, and then I explain you the real meaning of the term expenses. So please write this quickly and then we move ahead. Alright friends, once you have completed writing this whole thing, let me explain to you the meaning of the term expenses over here. This is something very, very important. Expenses are decrease in economic benefits. See, if I do not spend and if I spend, say I have $10,000 in my pocket. If I spend $1,000, the benefit that remains in my pocket will get reduced. So the moment you are incurring an expense, it is causing reduction in your wealth. Guaranteed. It is causing reduction in your wealth. It is causing reduction in the economic benefits that you have from your current resources. You incur expense, the economic benefits definitely deplete or decrease. So it results into decrease in economic benefits during the accounting period in any of the three forms. It could be an outflow. I just told you that you have $10,000 in your pocket, you spent $1,000, means there was outflow of $1,000 from your pocket. That is an indication that because of that outflow, your economic benefits got decreased. Of course, when you incur that expenditure, it is going to bring in some other form of economic benefit for its own, correct? For example, if I have spent that $1,000 in purchasing goods, so cash is going out, but goods are coming in. That means I have foregone one type of economic benefit and obtained another type of economic benefit. That is where every expense will have a corresponding economic benefit. Depletion of assets. Now, for example, you would have heard of something called depreciation, or earlier, sometime back I gave you an example that there will be, say, an expenditure of $40,000 for purchase of a machinery. The life of that machinery is 8 years. So logically, the cost of $40,000 should be spread over 8 years. This is done via depreciation, and the word depletion is very common to depreciation. It's very similar, though there is a difference between depletion and depreciation. I'm going to explain that difference later in this class. So depletion or depreciation is a gradual amortization of a lump sum amount of cost incurred over the life of that asset or over the period in which you are deriving economic benefits. Or incurrence of liability. For example, I have incurred an expenditure where there is neither any outflow nor any reduction in my asset value. I have made a purchase on credit. If I make a purchase on credit, the moment I make a purchase, it is an expenditure for me, but that purchase is made on credit. So there is no reduction in my cash, there is no decrease in any other asset value, but I have incurred a liability. I have assumed a liability because now I need to make a payment to that supplier of goods who has supplied goods to me on credit basis. So there may be incurring of expense by any of the three modes. It could be an outflow of cash, it could be reduction or depletion in the value of asset, or it could be incurring or assumption of a liability. Now what is the result of these? Result of this is decrease in equity. So basically when you incur any expenditure, I told you it is causing a reduction in your wealth, but it is other than one particular type of transaction. Suppose I have shareholders and I have made a payment of dividend to my existing shareholders. In that case also my wealth got reduced, right? But I cannot call that distribution of dividend as my expense. Why? Because that was the distribution of wealth among the owners of the entity, that is amongst the shareholders. Therefore, you have to be very clear that these expenses result in decrease in equity other than those relating to distribution to equity participants. That means if that outflow is causing distribution to equity participants, you will better call it as distribution of dividend rather than calling it as an expense. That is why it is excluded from the definition of expense. Now, I am sure you have already written this part, and we have further discussed something more, and that was the fact that if the financial statements were prepared on cash basis, neither revenue recognition nor expense recognition would be an issue. The firm would simply recognize cash received as income and cash payments as expenses. Under accrual method of accounting, expense recognition is in the period in which economic benefits of the expenditure are consumed. I have already explained to you this whole thing. You just need to quickly write it down and then we move ahead. Alright friends, once we have completed writing this much, let us move ahead and continue further. Three different methods are used for expense recognition. The first one itself is the matching principle. Now, just a few minutes back, I explained to you what is the meaning of matching principle. When you incur an expenditure, it will provide you some economic benefit. So, in whichever period you are obtaining or consuming that benefit, in that period you recognize the expense. Match the expense with the corresponding benefits. I repeat again, match the expenses with the corresponding economic benefits. That is what we call as matching concept or matching principle. Now, again taking that example of the machinery, we have spent $40,000 for acquiring a machinery which has life of 8 years. Logically, the cost of $40,000 should be spread over the entire life of that machine, because the economic benefits from the usage of the machine will be obtained over the period. That is over the period of that 8 years, which is considered as economic life of that machine. So any kind of capital expenditure when you incur, you have to match the expense over the life of that asset. Now, what is the meaning of capital expenditure and how it is different from revenue expenditure? A capital expenditure is such an expenditure that you incur now, but the corresponding economic benefit of that capital expenditure is for multiple accounting periods, more than one accounting period. However, if you are incurring an expenditure and the economic benefit of that expenditure is restricted only and only to the current financial period, then it is a revenue expenditure, and then to match that expenditure with the corresponding benefit, it is in the current period that you charge the entire expense. Matching principle plays a dynamic role in expense recognition. Second method is expensing as incurred. See, all expense cannot be having the related economic benefit where you relate it with any product. Let me explain this to you in terms of two different concepts, what we can call as product cost and what we can call as period cost. Now, assume that I am manufacturing this kind of remote controls. If I am making this kind of remote controls, I will be incurring expenditure for the material that is used for making this product. Various materials used for making this product, I will be buying these materials. So, purchasing these materials will be my expense. That expense is not a periodic cost, it's a product cost, because it is an expense towards making the product. It's one of the direct cost for making that product. It becomes part of the product cost. So when would you apply or when will you charge that expenditure in your income statement? When you are selling this component. So once you have made this remote control, one day you will sell it. The day you sell it, you are getting economic benefit out of that. That day you charge that expense. So what happens when you are talking about a product cost? You are making a product, you are manufacturing a product, you accumulate all the cost in each unit of the product manufactured by you. Then it becomes your inventory. Then you keep carrying the inventory as an asset in the balance sheet. You charge it as an expense only and only when you are selling that item. That is what we deal with, product cost. However, all costs may not be product costs. Some costs have nothing to do with the production. Those costs will be incurred irrespective of whether you are producing something or not producing something. For example, in the factory in which I am making this product, that place is not owned by me. I have taken that place under a lease. The monthly lease rental that I have to pay is $800. $800 of outflow every month is irrespective of whether I make production or not. Suppose to the lessor, that is to the owner of the property, if I say that, sir, this period I did not produce any product, so please do not charge rent for this period. Will it be acceptable? The answer is no. Rent will be payable irrespective of whether I make production or not. So if I do not produce, still I have to pay rent. If I produce, still I have to pay rent. I produce less or more, but I have to pay that $800 rent every month. Now, this cost cannot be considered as a product related cost. It is a periodic cost or simply period cost. So the treatment of period cost simply happens as per the second method over there, that is expensing as incurred. As and when you are incurring that expenditure, you charge it off into the statement of profit or loss. That is how we will charge the expense which are periodic by nature. And third thing is capitalization. So when you are incurring a capital expenditure, you need to capitalize your expenditure, means you need to create an asset out of that expenditure. Purchase of any kind of property, plant, equipment could be an example of a capital expenditure. Acquiring any intangible asset could also be an example of capital expenditure. Any expenditure that you are incurring now, which will have economic benefit over more than one accounting period, that expenditure primarily becomes a capital expenditure. And when there is a capital expenditure, what results into outcome is a capitalized value of that expenditure, and to arrive at that capitalized value of that expenditure, the process is called capitalization. In other words, you have created an asset. So when you incur an expense, where does it go? Generally, if it is expensed out, it will be charged as an expense in your income statement or the statement of profit or loss. But if it is a capital expenditure, it will be treated as an asset and will be placed as an asset in your balance sheet. Treating an expenditure as capital expenditure and putting in your balance sheet is what we call as capitalization. Now, capitalization may also have some extensive meaning. For example, any cost which is not primarily a capital expenditure, but pulling that cost and adding to the value of the asset is also called the process of capitalization. The capitalization of borrowing cost is a perfect example to that, but I'm not entering into the domain of discussing capitalization of borrowing cost right now. At later part of this class, we are going to discuss that in detail. So, using the matching principle, expenses to generate revenue are recognized in the same period as the revenue. Inventory provides a good example. I already explained you example of an inventory. Both the revenue from sale of goods and expense towards the inventory, that is cost of goods sold, are recognized in the period when the inventory is sold and not in the period in which the inventory was purchased. So when you are purchasing an inventory, it is your asset actually. Until sold, it is your asset. The day it is sold, then the cost of that inventory becomes your expense. So the revenue from sale of that inventory, which is typically your gross revenue or gross sale, and the cost of the goods sold will become your expense. So the sale proceeds become your revenue and the cost of goods sold become your expense. Both will be recognized as revenue and expense in the same accounting period. So I'm sure you have understood this matter. Let us now take an opportunity to write down this entire matter and then I take you ahead. Alright friends, once you have completed writing this whole thing, let us move ahead and take up an example on inventory. Let us read this example. The firm had 200 units of inventory at the start of the year and purchased a further 1,300 units during the year. The firm made sales of 1,400 units during the year. 100 units are unsold, are lying as ending inventory. What will be the effect on income statement and balance sheet with respect to the quantity of inventory as informed? So now this is where you need to apply the matching principle with respect to the sale of goods. Please observe one thing. You should always be in a position to reconcile the quantity and then the revenue and cost matters can be incorporated. So if we observe 200 units of inventory was lying with you at the beginning, you made a further purchase of 1,300 units. So 200 units were already there, you made a further purchase of 1,300 units. So the total quantity that was available for sale becomes 200 plus 1,300, that is 1,500 units. Out of this 1,500 units available for sale, the actual sale that has happened, that is 1,400 units. So obviously the units that were lying unsold by end of the period was 100 units. So when you record the sale will be with respect to 1,400 units. So cost of goods sold should also be for 1,400 units. So how do you do that? You will arrive at opening inventory, that is inventory at the beginning, 200 units. Fresh purchases made 1,300 units. Total quantity available for sale will be 1,500 units, that is 200 plus 1,300. Out of this 1,500 units, 1,400 units which have been sold, the cost of these units will be stated as expense in the income statement. So the proportionate cost of 1,400 units will be placed as expense in the income statement, and the cost pertaining to those 100 units that have remained unsold will be placed as your inventory at the end, and that will be an asset in the balance sheet. So corresponding 100 units cost will be stated as closing inventory or ending inventory in the balance sheet as an asset under the head inventories, which are current assets, and the cost of 1,400 units which are sold will be treated as an expense under the head cost of goods sold. So let me show you how would you write up the answer to this. In your answer, you first write matching the units of cost of goods with the sales quantity. So you start with the sales quantity in units, that is 1,400 units. In the inner column, I am recording the beginning inventory, adding purchases to that. So available for sale becomes 1,500 units. Mind it, cost figures are not taken over here. All these calculation is in quantity terms only. Ending inventory we subtract from the total available for sale and we get the cost of goods sold. So now if you observe, the ending inventory is your asset which will be stated in balance sheet. So you transfer these 100 units to balance sheet and it will be reflected as an asset in the balance sheet, and these 1,400 units which are sold, this will remain in the income statement and will be considered as cost. Now look at one thing, 1,400 units which you have sold, its cost would match with the 1,400 units revenue that you have earned from sales. So matching principle wants this 1,400 units of cost of goods sold to match with the the 1400 units of sale actually. Now this is just the quantitative reflection. In the follow-up example, we will be considering the cost and revenue aspect as well. But first you write up this whole thing and then I take you ahead.